Bandhan Mutual Fund presents MF Corner.
Hello and welcome to the special edition of Mutual Fund Corner, YouTube edition. And we are here as always to solve all the investor mutual fund queries and doubts that you all have when you all are investing in mutual fund. For today, the first topic that we're going to be discussing is what should an investor do when they are investing in mutual funds and actually the mutual fund starts underperforming. What are the steps that you should be taking there? And to talk all about that, we have our expert for today. We have Kirtan, Shah, founder and CEO at Credence Wealth Advisors, joining in with us. Kirtan, thank you so much for joining in with us on the show. And this is a very big doubt, right? Suddenly you see that the markets are falling and then you see that there are concerns coming in because your mutual fund has started underperforming now. So first, to start with, what are the specific metrics that one should be looking at, or as an investor that they should be seeing while assessing whether their mutual fund is underperforming? What is the key trigger that one should be watching out for before you see a sharp fall?
Hi, Vinnii. Thank you so much for having me on the show. I think this is a very interesting question because typically what happens is, as a retail investor, and I've seen this, that a lot of times investors have no idea as to why they've invested in a particular fund. And when you only look at the last 3 years, 5 years return to actually invest in a particular fund, that's exactly when the underperformance starts kicking in as a problem to you, because you were not very sure at the first stage as to why you invested in those funds. And this is a typical problem if you look at returns and invest in any fund, because you will never have confidence whether you've invested in the right funds or not. So the typical way to do this, Vinnii, first is to understand that no fund on a regular basis will really be able to outperform the index. And once you understand this, you will understand that you will have to stay invested for a slightly longer period of time to make sure that your fund is given enough and ample opportunity for it to be able to show the performance. Now, having said this, to answer your question specifically, there are 2-3 matrices that you really look at to be able to understand whether your fund is doing well or the fund is not doing well. The first thing that you do is you compare the rolling returns of your funds with the respective indices and the category average. It is extremely important to consider not only the index but the category average also, because there are some times where the funds, because of the way the SEBI structure is, will find it difficult to be able to beat the index. And hence, you also want to look at it in a way where the fund is not performing the category average. So you look at both, whether the rolling return is doing good versus the index, and the rolling return is doing good versus the category average. That's the first matrix that you look at. The second thing that you look at, in my opinion, is you also look at risk, because you cannot only look at the returns and say that my fund is not doing well, because that will be very limited opinion on a particular fund. So you look at the risk. In my opinion, you look at something called a standard deviation. You also want to make sure that your fund's standard deviation is lower than the index and the category average. If it is lower than both of them, then I think you are in a comfortable position. The third metrics that, in my opinion, you should look at is something called as alpha, because you also want to look at it saying that for the risk that my fund took, has the fund really been able to deliver returns more than the risk it took? And alpha is a very interesting matrix. So you look at all of these 3 things, and only then you come to a conclusion whether your fund has underperformed or not. And mind you, fund will never be able to beat all of these indices and all of these matrices that I spoke to you of on month or week on week. So please don't look at just 1 month performance or 3 months of performance and say that your fund is underperforming. Give it at least 10, 12 months before which you end up making this conclusion.
Okay, at least a 10-12 month horizon that one should be looking at before someone actually makes this decision. But Kirtan, what I want to understand, what if someone is actually holding it for a long term? Then how does one judge this mutual fund, right? Like you said, 10-12 months, but what if I've already been holding the mutual fund for 3 years? Then, what is the time period that one could be looking at? Should they just continue to keep holding this for the 12-month period that you were mentioning?
I think, Vinnii, what you and I have to understand in this case is that while somebody is investing in a particular fund, every fund has a different style of investing. right? Now, if you see broadly, there are funds which follow value style of investing. There are funds which follow growth style of investing, and there are funds which follow momentum style of investing. Now, it's extremely important for us to understand why has the underperformance come, because unless we don't understand why the underperformance has come, we'll never be able to conclude whether or not do we really want to continue holding it or not. So let's say, for example, if you look at the last 12, 18 months, we've seen that the value style of investing has done really well. But at the same time, momentum and growth style of investing could not do well. Now, if you've understood that the fund is underperforming because the style is not favoring the market, then you might as well want to hold on to the fund, because at some point in time, growth and momentum style of investing will come back to flavor, and hence your fund will start outperforming again. So if the underperformance has happened because the style is not very favorable, then I would suggest that you continue to hold on. But if the underperformance has happened for some other reason, where the sector calls went wrong at the fund's end, they took a lot of concentration on a particular stock or theme, and the fund is underperformed because of those problems, then you might want to consider getting out of the fund and investing it somewhere else. So I think the answer to the question is for us to understand why has the fund underperformed, basis which we'll be able to judge whether or not should you give it more time or should you consider switching the fund.
Okay. And what about external factors, right? Market conditions, geopolitical tensions. There are times that could specifically impact some segments or sectors that are maybe there in your mutual fund portfolio. So how should one be actually getting influenced by these conditions, right? If you see something happening maybe in one of the sectors or something that could impact the mutual fund, how do you take those steps? Do you take any steps earlier to mitigate these risks, or what should one be doing?
I think, Vinnii, in my opinion, that is something that is outside of retail investors' preview, or probably not something that you should put a lot of focus on, because in my opinion, as a retail investor, when you invested in a mutual fund, you want to give that leeway to the fund manager to decide which sectors and which stock does the fund manager think there is a lot of interest in and they should be invested in. Now, if there is an external factor, specifically global, I think that is going to impact the market temporarily in a particular direction. And because your fund is more diversified, the impact on your fund is not going to be very significant, because some part of your portfolio will be invested in that particular sector or in that particular stock. And I think as a retail investor, these are very macro things that you should not typically look at and let the fund manager do his job. Because in my opinion, if you have 3-5 years of investment horizon and you've invested in a well diversified fund, I think most of these things will be balanced out because of the diversification that the fund will really have. So I will not give a lot of weight to a very specific sectorial move in a more diversified fund, because I think the fund manager is in a better position to take calls on what he or she really needs to do in terms of moving sectors or rotating sectors.
Okay, and specifically just on that topic, what if actually we are starting to invest in those sector funds? Then should you be maybe looking to get out of it if you know that the sector is not going to be performing or it's underperforming? Then how do you look at it?
Oh, 100%. I think, in my opinion, sectorial funds to a larger extent are not meant for retail investors. I think sectorial fund is more of a professional investing game, because what typically happens is that if you are investing in a particular sector, looking at the last 2-3 years of performance of that particular sector, you're definitely in for a surprise, because you look at the last 2 decades of data and you will understand that no sector linearly only goes up, right? So if you've looked at a particular sector which has done very well in the last 12-18 months and you invest in that particular sector, you probably are in for an underperformance going ahead for the remaining 12-18 months. In my opinion, when you do sector investing, it has to be more a value bet, where let's say over the last 2-3 years, that particular sector has not done well and the valuations are in favor, which is why you should invest in that particular sector. Only then you will have a probability of that sector ending up doing well for you over the next 12-18 months. But if you've looked at the last near-term performance and invested in that sector, probably you will have to give that sector a lot of time in terms of investing for you to really be able to justify the kind of returns that you are expecting that sector will make for you. So in my opinion, sector investing is definitely more sophisticated investing, because not only the time at which you should invest in that particular sector is extremely important. If you don't get your timing right of exiting the sector, you probably will end up underperforming the broader market, because all of these sectors are extremely cyclical. And if you miss the entry or the exit point, you probably might underperform the broader markets for over 2-3 years.
Okay, Kirtan, thank you so much for joining in with us on the show and, explaining our viewers to not actually panic and start worrying if the mutual fund is just started underperforming. Maybe wait and actually judge where it's going. 12-month time period is what we should be watching out for, at least before you judge your mutual fund or start exiting it. Thanks so much, Kirtan, for joining in with us.
Thank you so much for having me.
Bandhan Mutual Fund presents MF Corner.